Thanks for joining us today for a quick chat about the economy here in 2022. The new year is off to a start. My name is Megan McCarthy Collins. I'm one of the partners and advisors here at McCarthy & Cox. I also have with me Wes Bean. He's our Chief Investment Officer at McCarthy & Cox. As a couple of reminders, kind of housekeeping items before we jump in today, our webinar is being recorded and pending compliance will be available for viewing in about a week. It'll be posted to our YouTube channel as well as sent out by email to those folks registered today. We're going to hear from Brad McMillan today, and at the end of our session, we'll be taking your questions. Don't hesitate to send them to us as they come up throughout his presentation. And please send those to us by email to info@mccarthyandcox.com. We'll attempt to answer these questions at the end of the webinar today. And if we don't get to them all, we'll follow up with you after, of course. We chose today's topic really because due to the ongoing pandemic, there's still a lot of concern around the economy, markets, inflation. You may have seen or heard our guests today on Fox Business, Yahoo, CNBC, Bloomberg, Kiplinger, Forbes, just to name a few. We're joined today and we have the pleasure of the company of Commonwealth's Chief Investment Officer, Brad McMillan. Welcome, Brad. Thanks for joining us today. I'll let you introduce yourself and get us started.
Thank you very much, Megan. And as always, it's an honor to be here. I have spoken to you all before, and as I always say, it's an honor to be invited. It's a much bigger honor to be invited back. So thank you for having me. What I want to talk about today is looking a little bit beyond the numbers, because most of the economic coverage that you see really is based around the numbers that are out there. This report, that report, this is what happened today, this is what happened yesterday. And to really understand what's going on, it's important to not just look at the numbers, but to look at the context of what those numbers mean. So that's what we're going to be talking about today. And as far as where I'm coming from on this, I'm the Chief Investment Officer of Commonwealth. We're the back office for McCarthy & Cox. And I work with advisors and with clients around the country. So, I have a chance to talk to people pretty much in every area. And this represents what a lot of people are asking about. But as Megan said, if there's anything that I don't hit on or anything you want me to dive deeper on, please send a question in and we'll be happy to get to it. So with that, I'm going to share my screen here and look at some charts because, I'm an economist. We have to use lots of charts, right? So in this case, though, I think what we get is we get some valuable information, again, beyond the numbers as we look at the charts. And to start off with, what I always try and do is talk about where we are now. Because if you don't know where you're starting, you don't know where you're going, and you don't know where you're going to end up. And I think there's a couple of points here that really define where we are at the moment. The first is that the Omicron wave is in full swing. We're seeing a tremendous number of infections out there. The positive test rates are still incredibly high. Hospitals are still under enormous stress. In other words, we're not through this by a long shot. But on the other hand, all of the data out there shows signs of a peak, and we'll see that on the charts. It's not that things are good. They're not good. They're still terrible. It's that they've stopped getting worse and they've started getting better. Now, that's not the case in every region. In some areas, we're still seeing infections increase. But as a country, we look to be through the worst of it. And that's enormously good news because from an economic standpoint, the second point I want to make is we're likely to ride this out. I don't want to minimize the medical risks out there, which, as I say, are still very real. But at the same time, from an economic point of view, our real fear was, is this going to be a replay of the first wave where everything shut down? Is this going to be a replay where we're really looking at a nascent depression? It doesn't look that way. When you look at the infections, yes, they're sky high, but they're dropping quickly. The country is still open. So all of the damage that was done by earlier shutdowns, we're not going to see that. And as the infection rates start to drop again, chances are the country is going to stay open. And we have a lot of cushion from economic demand. Both consumers and business, despite the Delta waves, despite the Omicron wave, are still confident in spending. In other words, this is something that we are going to be able to ride our way through. We've still got another couple of weeks, a month, maybe two of medical risk, but the economy has enough momentum to carry through. And that's one of the things that have supported markets. Until very recently, we've seen a sharp pullback, but the markets largely expected a continuing recovery. When you look at earning projections, you see expected earnings growth continuing. In other words, from an economic perspective and from a fundamental perspective, the markets were looking at the world and saying, yeah, we kind of like it. Now, we've seen some pullbacks there, and we'll talk about that too. But the fact of the matter is those fundamentals are still quite solid. And that's something that says, okay, we're seeing the pullback, but it doesn't look like it's going to get too much worse than it is. It might. We always have to expect more volatility, but solid fundamentals provide a cushion for the market. And I think that's what we're going to see going forward. So those are the three things I want you to have in your head as we start here. First of all, the Omicron wave is still terrible, but it's getting better. Second of all, the economy has the momentum to ride this out. And third of all, that strong economy is going to cushion the market volatility we're now seeing. So let's take a look at the data for the details. This was done as of about a week ago. You can see here, you can see the first wave, which seems mild in retrospect. You see the second wave, and then you see the third wave. And this is when we reopened for the first time. And we really got hit hard. And we had never seen anything like this. But then things got better until we got into July of last year when we thought we were done. But then Delta hit. And we saw the first Delta wave. And we were starting to see the second Delta wave. And then Omicron came. And it's just taken off. And when we were in this section of the curve, what we were wondering is this just going to keep going? And we had reason to believe that it was going to roll over because that's what we had seen in South Africa. That's what we had seen in Israel. And South Africa was the very first emergence of Omicron. So that was the best and most detailed data we had. But we weren't sure. Now we're starting to get sure. This data is a little bit dated. We're down to about here. It's come down here in the past week. Okay. Average 7-day average infection growth has dropped by about 25% in the past 10 days. We've seen a significant decline, and that's likely to continue. And that's likely to continue for a couple of reasons. First of all, Omicron has spread so fast that pretty much everyone who can be infected will be infected. But because Omicron does seem to be milder, a lot of infections aren't even showing up in the data. So when you look at this, if we have 800,000 average infections at the peak, that might be several million real infections. The others just aren't being reported. And when you look at the number of people who have been vaccinated and who have already been exposed, you're starting to run out of people who are most vulnerable to infections. And that seems to have been exactly what happened in South Africa. And when we look at this, we can say, okay, this is something that says this should drop quickly. If we follow the South Africa model, we're talking about weeks, not months. We're talking about a much sharper drop than what we saw here or here. And that's good news because that means we can weather this short but sharp increase. But it's not just the case numbers that are showing this data. When we look at the positive test results, we see the same thing. Now, this is noisy data, but again, it's come down further over time. And when you see this, you see positive tests. People who were taking tests, they went up to over 25% positive, and it's now come down to close to 20. Now, this still isn't good. We're still above where we were, but it's moving in the right direction and it's not getting worse. And here again, this is interesting because a lot of the tests out there, we now have home tests, which we didn't have in prior waves. So again, the people that are getting these tests are much more likely to be positive. And because of that, we should expect it to be higher. But if things are getting better, we should also expect it to decrease. And that's exactly what we're seeing. But of course, that doesn't really talk about the risk to the healthcare systems. Because Omicron is more infectious and because we have so many more cases, even though it is milder, you can still have a larger number of people in the hospital. And that's what has put hospital systems under stress. But here too, as of a couple of days ago, we can see it's starting to roll over. And since then, it has come down further. We do seem to be past the peak in hospitalizations as well. And because we know from prior waves that there's typically about a 2 to 3 week lag between the case growth and between the hospitalizations, that also provides further supporting evidence that we're a couple of weeks past the peak in cases, which again is exactly what we're seeing in both the case data and the positive test results. All of this data is saying the same thing. It's a short wave, it's a sharp wave, but we are past the peak and we should be recovering. And when we look at South Africa, because remember, this was going to be what we were hoping we would be like. And here too, you have the very sharp couple of week increase and then the fading over the next 4 to 5 weeks. We're about 2 weeks into that. So if we follow this pattern, and as I say, all of the data suggests that we are, we've got maybe another month. And that's good news because we can last another month. We can make it through this as an economy. We can stay open since we know that things are going to get better. And that's exactly what's happened. Arguably, some of the shutdowns in prior waves were unnecessary. We didn't know at the time, that's what we did. But the shutdowns caused enormous economic damage. And when we look at this wave, the question is, what's the economic damage going to be? We know it's not zero. We know there will be economic damage, and it's already showing up in the statistics. But to get the kind of nascent depression that we had then, we had to have widespread shutdowns. We haven't seen them. We're not going to see them. In fact, even the slowdowns we're seeing in activity are likely to fade in the next month or two, as they've done with previous waves. So from an economic perspective, those medical charts say that we're going to get through this. But again, let's take a look at where we are, because there's a couple of key things when we look at the economy that we need to pay attention to. The first is the labor market. Consumer spending is over 2/3 of the economy. If consumer spending is strong, the economy is doing well. And for consumer spending to be strong, you need two things. You need a strong labor market. And we actually have a very strong labor market. And we need strong consumer confidence. Yeah, people may be making the money, but they're not going to spend it unless they're confident. Right now, we have surprisingly high confidence despite Omicron. We have rising wages supporting that spending ability. And even when you take out inflation, when you look at real consumer spending, it's held up very well through both the Delta waves and, as far as we can tell, through the Omicron wave as well. In other words, over 2/3 of the economy is doing very well. The rest of the economy is the government and business. We know about government spending. That's kind of up in the air. I don't want to get into that. But the other major component is business. Business is actually, as a group, more confident than they've been in about the past 15 years. Business is extraordinarily confident. And even though they have their concerns, they can't hire people. From an economic perspective, that's actually good news because they have to keep investing. If you can't hire people, you got to invest to put capital in place. So that's actually another tailwind. So when you look at the economy itself, despite the waves we're seeing, we see strong demand, we see strong investment. And again, that's something that gives us momentum to ride out this wave, exactly as we've ridden out previous waves. In fact, if you look at the job gains, you can see the sharp drop here. But you can also see that sharp recovery. And bear in mind, this strong recovery in 2021 occurred during the Delta waves and during the Omicron wave so far. Big picture, we're still not back to where we were, but we continue to make extraordinary progress. And when you start to dig into the details, it's not that there's no labor demand, there's a ton of labor demand. Is that there aren't enough workers. If you look at the number of open jobs out there, the highest we saw before the pandemic was about 7.75 million. We're up to about 11 million now. Those are millions of jobs out there going begging. And obviously from an employer's point of view, that's not good. But from a worker's point of view, that's really good news because you're not going to get laid off. Layoffs are actually, they're still below pre-pandemic levels, but they dropped down to some of the lowest levels we've ever seen. That's remarkable. If you can't hire, you're not going to get rid of the employees you have. Layoffs are extremely low. Quits are extremely high. People know that they can go out and get a better job. They know they can go out and make more money. And there's no purer measure of the strength of the labor market than being able to say, hey, take this job and give it to somebody else. And note that that has gone up even through the Omicron wave, even through the Delta waves. People still feel confident. And in fact, there's starting to be good news out here because the labor market is so strong that people are starting to come back into it. Yes, there's a worker shortage, but people have been scared out of the labor market or they haven't come back for whatever reason. They're starting to come back. You can see here that the number of people who want a job and who don't have a job typically is somewhere between 5 and 7 million over the past 10 years. It spiked up to about 10 million, but now it seems to be holding at about 6, right in the middle of the range. In other words, not only is the labor demand strong, the labor supply is starting to respond to it. And that's going to help business as well. And that's going to help both spending and confidence. And in fact, you can see this in the most recent consumer spending data. Now, there's two different surveys here. I don't want to talk about them. But the first point I want to make is the uptick here. You've seen confidence start to bounce up. Now, this light blue line, the Conference Board survey, that's more oriented towards workers. And you can see that confidence is actually extremely high. It's higher than it was before the financial crisis when conditions were pretty good. It's not quite as high as it was just before the pandemic, but still very healthy. And that says that workers and consumers are actually very confident. Now the Michigan survey, the dark blue line, is a little bit different. This is focused more on business owners. And business owners are the ones who are dealing with the supply chain issues, the worker shortage. They're not nearly as confident. But at the same time, it seems to be holding to where it is. And that's actually really good news because it says that even with the Delta wave, even with the Omicron wave, it's starting to bounce. So I look at that and I say, okay, the confidence is still there. And with confidence on the consumer side and with job growth, you're seeing more spending. Now, part of that's being absorbed by inflation, and we'll talk about inflation as we go. But nonetheless, even if you back out the effects of inflation, this is real retail sales, it's holding steady. That's despite the Delta waves, which are about right here and right here. It's despite the Omicron wave. In other words, the consumers, which is to say you and me and all of us, are out there spending. And with business confidence as high as it is, I mentioned this earlier, take a look at where this is. This is what's called a diffusion index. Basically, if it's above 50, businesses are hiring and want to expand. If it's below 50, businesses are pulling back and contracting. You can see that happens in recessions, the shaded areas. And you can see it happen very sharply at the start of the pandemic. But right now, business confidence is as high as it has ever been, going back to the late 90s. If you think about that, that's remarkable. And with business confidence and with the labor shortage, businesses are growing their investment. The light blue line is confidence. We just talked about that. The dark blue line is how much businesses are growing their investments. And you can see here again, we're very close to the highs of the past 25 years. The labor shortage isn't going away. It's getting better, but it's not going away. Demand is strong, confidence is strong. We're going to continue to see business investment increase, and that's going to be another tailwind for the economy. Now, that's not to say we're entirely out of the woods. You know, I get a lot of questions about inflation. Inflation is at 7% year on year, and that's the highest we've seen since 1982. And that's absolutely true. But there are two questions that go with that. First of all, why is it so high? And second of all, is it going to stay that high? And the left chart here addresses the first question, because the light blue line is the inflation over the past year. It's about 7%. You can see that. And that's ridiculously high. But then the dark blue line is the inflation over the past 2 years. And you see, that's only about 8%. In other words, in the first year of the pandemic, we had inflation of about 1%. In the second year of the pandemic, we had catch-up inflation of about 7%. And that's what it is. It's catch-up inflation. Demand jumped because of the federal stimulus programs. Demand shifted because people couldn't spend on services. They couldn't go out to restaurants, so they bought TVs. And both of those things pushed prices up. But both of those things are now starting to pass. And what's interesting is if you look at that and you say, okay, inflation went up because of the pandemic, you can reasonably expect inflation to go down. And in fact, that's exactly what we see in that Michigan survey. If you look here, you can see that the expected inflation rate for next year is just under 5%. And wow, that's really high still, but it's lower than 7%. In other words, even the paranoid people who run businesses expect inflation to go down over the next year. And if you look at expectations for inflation over the next 5 years, that's down to about 3%. In other words, what common sense tells us, demand is fading, supply chains are improving, so price increases are going to go down. That makes common sense. And that's exactly what we're also seeing in expectations. Is inflation extremely high? Absolutely. Why is it extremely high? Because of the pandemic. As the pandemic fades, so will the inflation. And that's exactly what we're seeing in the data. And when we look at one of the underlying factors that I just talked about, one of the things that's pushed inflation up is supply chain issues. Well, but again, this gets us to why did it happen? And is it getting better or worse? Well, why it happened, factories shut down because of the pandemic. Everything shut down because of the pandemic, and the supply chains were totally messed up. And you can see here the problems. These are all indicators from the ISM survey. You can see problems rising for supply chains. Absolutely, it happened in the pandemic. It's gotten worse since then, but in the most recent data, despite Omicron, it's starting to roll over. Just as with the pandemic itself, and for the same reasons, we're seeing the data actually start to roll over and get better. Does that mean we're out of the woods? Absolutely not. But it does mean that companies are learning to adapt. We're seeing shipping relocating from the West Coast to the East Coast. I gave a talk to a group in Baltimore, and the person there said, yeah, actually our port is as busy as it's ever been because ships are coming in. The world is adapting. Just as kind of a funny example, if you think about Tim Cook, the CEO of Apple, is he looking at this data and is in the boardroom and saying to his people, you know what? We had a good run. I guess it's over. I don't think so. I think what he's been saying is we have a problem, fix it now. Now, obviously, it doesn't get fixed now, but it does get fixed over time. And that's what the data is showing us. And that, I think, is where we are with both the pandemic and the economy. Things have been bad, but they keep getting better. We've got the strong jobs market supporting the consumer. That's a trend that's not going to change. We've got business very confident because of that strong consumer demand, and that's not going to change. Oh, sure, it could change if we had a long enough pandemic. But again, we've seen it's peaking, it's starting to get better, and we've got a lot of cushion to ride through that. So from an economic perspective, I think we're going to do just fine. But although the markets have believed everything was going to be just fine until very recently, they started to have some doubts. And that's why we've gotten the pullback that we just have. But despite that pullback, the fundamentals are still solid. And I think it's important to take a look at where stock prices come from. There are two things really that determine what stock prices are. The first are earnings. Companies make a certain amount of money, and that's a fact. But then the thing that can vary is how much people are willing to pay for those earnings. So when the stock market pulls back, it's one of two things. Either earnings are starting to go down, or we're going to see valuations go down. People are simply willing to pay less for that stream of earnings. And when you look here, you can still see earnings growth is expected to be quite strong, between 10 and 15% over the next year. That's pretty healthy. And that gives us a lot of cushion. And in fact, analysts are actually usually too conservative, so you can reasonably expect it's going to be a little bit more than that. So when you look at this, you say, okay, it's not the earnings that have taken the market down. It must be the valuations. And what's interesting here is you can see what these blue numbers are. It's what's called the price to earnings ratio. And it's how much the S&P 500 stocks, the S&P 500 index, are as a multiple of the amount of money they're expected to make over the next year. And you can see here that ever since the pandemic started, it's been somewhere between 20 and 22 times. It's been remarkably consistent. Now, just now, we pulled down to a little bit below 20. So we're at the lower end of that range that we've seen. But we can take a couple of other things here too. If we look at this, we can say, okay, before the pandemic, it was generally between 16 and 18 times, okay? Dropped below a couple of times, but generally it was between 16 and 18 times. And before that, it was even lower than that. So we've seen valuations rising over time. And why is that? It's because interest rates have gone down. When interest rates go down, stock valuations go up. And I'm happy to get into the details on that, but for the moment, just take it as a fact. So when interest rates go down, as they were cut significantly during the pandemic, you would expect to see valuations go up, and that's exactly what we saw. Now, as interest rates are starting to go up, and in fact, there's a Fed meeting today, there's a fear that interest rates are going to go back. But if they go back to where they were, if they go back to where they were before the pandemic, we can expect valuations to go back to between 16 and 18 times. But the thing is, they're not back there yet. And it's a very open question whether they're going to get fully back there. So when you say markets are adjusting down to about here, that means they're moving back towards that range. But as we've seen in the most recent performance, markets are starting to question whether they should move back there. So that's kind of what's going on with the markets. And what does this tell us? Well, I think it tells us two things. First of all, there is a reason for the volatility we've seen. Second of all, that reason, along with the strong fundamentals, actually constrains the potential effect of that volatility. We said earnings were going to go up about 15%. Okay. That'll absorb a decrease in multiples of about 3 points. Well, that could take us from where we are right now down to there. So over the next year, we might see the stock market flat as valuations go down and earnings go up. In other words, there's a cushion there. Are we going to see more volatility? Yes, very likely we will. But is this irrational volatility? No, it's not. It's a response to changing market conditions. And as investors, this is something we have to expect. The pullback we've seen was fast, but it's well within the range of what we've seen before. It's responding to changes, real changes in interest rates. And it's something that in many respects is actually good because it means both the economy and the markets are moving back to normal. It's not fun. I don't want to minimize it. I don't like it either. But it's something that says that we're moving back to something like normal. And that's actually a really good sign. And that, I think, is where we finish up. Omicron is still very much with us, but it's starting to roll over. And despite that, consumer confidence and spending are holding. Business confidence, investment are very strong. The economy is in a good place to ride out this wave, and it looks like we have enough momentum to carry through. What we're seeing in the markets is markets are adjusting their expectations. Markets had very high expectations. Maybe they're starting to get a little bit closer to reality. And that's a good thing. But even as we're seeing volatility, and we might see more, the economy should support earnings. Earnings should support the markets. And right now, there's so much negative news priced into the market. We actually could see the news start to be a tailwind rather than a headwind, as things turn out to be not quite as bad as we think. In other words, despite the pullback, we're still doing pretty well. Despite the pullback, the fundamentals are still pretty solid. Despite the pullback, there's still a lot of cushion here for both the economy and the markets. And that's not a bad place to be. With that, I'll just say I'm on Twitter, I have a blog, I do a webinar. Buy my book. It's the best book I've ever written. And I will leave it to Megan or Wes to read the disclosures.
As always, it's very insightful. We appreciate hearing from you. And I'm going to turn to some of the questions that have come in now. So one that we just got in is this: as a retiree, I'm sitting on some cash that can be invested. With inflation, interest rates being down, or inflation, interest rates being down, bonds being depressed, and the current economy and growth, I struggle with where to invest based on these conditions. Any suggestions that you can share?
Big picture, I will defer to your financial advisor because they're much more familiar with your individual situation. I guess more broadly, though, I think personally, one of the things I'm looking at is differentiating between income risk and capital risk. So for example, as a retiree, if you're looking at something that generates income, but I might consider dividend paying stocks. And the argument against those and for bonds is, well, with bonds, you get your money back. And that's absolutely true. There's much less capital risk potentially with bonds because stock prices, as we've seen, can fluctuate. But at the same time, from an income perspective, over time, that income producing stock is very likely to show increasing dividends. The stock prices can go down, but they can also go up. So from that perspective, I think dividend producing stocks might be a good place to be looking in. Other than that, I think the thing you need to consider when you're looking at bonds, though, is the role of bonds in a portfolio. Part of it's income. Yeah, that's true. But it's also as a diversifier, as cushion for something that for the stock part of it. So we're not just looking at bonds for income. So when you're evaluating your bond holdings, I think you need to be very aware of that and not say, well, interest rates are low, this doesn't make sense. It can make sense. It does make sense. But if you're looking for something a little bit different, maybe talk to your advisor about dividend paying stocks.
Okay. All right. Thanks, Brad. Another question that we received is 2019, 2020, and 2021 were all good years for the S&P 500. So good for stocks here domestically in the U.S. Do you expect this U.S. outperformance to continue? Are there other areas that you would be looking at? And sort of a secondary question to that, or comment to that, is this person that sent this in believes stocks are expensive right now, or U.S. stocks are expensive. So again, are there other pockets, other pockets of the market, other markets that you might look to if given the outperformance in the US over the past few years, and even longer than that, really?
I think it's a great question. And I mean, there's two different ways we can kind of slice that data. First of all is when you look within the US market, most of what we've seen in terms of the returns has come from what are called growth stocks, companies that are rapidly growing. Investors are willing to pay up for that growth. So, we've seen a certain part of the market really disproportionately benefit from that. And since these tend to be large companies, think about the FanMag stocks, Facebook, Apple, well, it's Meta now, Facebook, Apple, Netflix, all of those are very, very large companies. And since most of the indices are capitalization weighted, they have a disproportionate effect on the indices. And obviously, we've seen a big pullback on tech recently. So, you might say, well, the indices are doing this. But then you start to look and say, wait a minute, there are companies in here that aren't part of that growth cohort. They're actually not trading at such high valuations. So when you look at, for example, well, I have growth allocation here and I have value allocation here. Now is when the value stocks, some of the more defensive stocks, are starting to outperform. So don't assume that the indices represent what's going on within the market itself. There are always opportunities. And again, this is something your advisor, has built your portfolio to include representation of those other areas. Certain parts of the US markets are going to do well, other parts less well. Right now, we're kind of getting hit on the indices because of that pullback in the growth stocks. Now, if we then start to take a look at international markets, it's interesting. We talk about international markets. It's kind of like talking about food. Is food good for you? Well, I don't know. Are we talking about kale or are we talking about ice cream? So that's kind of where I am with international markets. If you look at Europe, for example, there's very significant demographic challenges. There's growth challenges. But then you look at some of the emerging markets and there's just enormous population growth, enormous potential going forward. And then you bring in valuation. So it's more a question of, are there opportunities overseas? Absolutely. Would I say China is one of those? Maybe not, because I have some real concerns about China. So what you want to do is you want to pick managers who can kind of negotiate what's going on there. There's always going to be opportunities in the US. There's always going to be opportunities abroad. And one of the things, I'm a macro guy. I look big picture. So I understand the appeal of, oh, no, this isn't good. Valuations are too high. Valuations are too low. But that's not how you invest. How you actually invest is looking under the covers and picking out the nooks and crannies within each of those areas that make sense. And that's how Commonwealth tries to help your advisor, identifying those managers who are doing just that. So should you be an international? Yeah, I think you should, because frankly, if you look at the indices, I do think there's some challenges there. And also because we don't know, I certainly don't know what's going to happen next. When you look at diversification, you want to be exposed to the things that you don't know are going to go up, because you're going to be exposed to the stuff you don't know is going to go down. And again, that's what we've seen in the past couple of days.
All right, thank you. And we've seen a lot in the news lately around the Ukraine and Russia and what's going on there. And can you tell us what's going to happen there, first of all, but can you tell us how that might impact, or what are your thoughts around how that could impact the markets here? Any risk that you see from that, or other geopolitical type or events like this around the world, so particularly the Ukraine and Russia situation?
That's kind of a broader question, and the way I would phrase it is, okay, if we have a war, what happens to markets? And in the short term, they're going to get hit. I mean, uncertainty, we don't know what's going to happen. It's the end of the world, markets sell off. But longer term, do you remember when the US assassinated the Iranian commander a couple of years ago?
Yep.
And there was a lot of panic, there was a lot of chest beating, and at the end of the day, nothing happened. And my guess is we'll see a short-term reaction because uncertainty. Longer term, I actually looked up what we export to and import from Ukraine, and it's about $30-odd billion, which in the context of a multi-trillion-dollar economy is nothing. So from our perspective, there'll be a little bit of panic, but it won't do anything. From Europe's perspective, it's going to be tougher because the Russians, if they invade, are probably going to cut off natural gas to Europe in the middle of winter. Europe's going to have a tough time. But again, that kind of gets into how do we look at markets? Europe, I might not make a short-term bet. Over time, they'll be fine. But again, that's going to be an issue. So short answer, nothing, it doesn't matter over time. It matters to the Iranians. I don't want to minimize it, but I'm not worried about it.
All right. The Fed, another question that came in is around the Fed and their tapering and potential rate hikes. How much do you expect, or how many times do you think the Fed will hike rates this year? And normally when rates go up, we think that rates go up, bond prices go down. So is this priced into the markets, or in your opinion, is a potential for Fed hikes priced into bond prices at this point? And I guess the second part of that is like, how many hikes do you see, or what are you guys thinking about the Fed and what they might do over the course of this year?
You don't actually have to guess how many hikes the market expects. You can actually do an analysis and look at the structure of the rate curve and figure out mathematically what the market is expecting. And right now, the market is expecting about 4 rate hikes. And in fact, I think that's even ticked up a bit recently from the last time I looked, because you got people like Jamie Dimon, the head of JP Morgan, saying we're going to see 5 to 7 rate hikes. You've got other people saying, oh, it's going to be more than that. So the expectations and what's in the market are for very significant hiking. And even beyond that, there's talk about quantitative tightening, the Fed taking down the size of its balance sheet. In other words, everybody at this point is pricing in an extremely hawkish Fed. So the question is, when you look at the markets, when you look at the bond markets, is it going to be more hawkish or less hawkish than what the market's expecting? I actually think they're going to be less hawkish than the market is expecting, and that could be a tailwind for interest rates and bond prices. And the reason I say that is the Fed is, yes, they're worried about inflation, but they've historically been very cautious. So there's a lot of talk about 50 basis point increases, in the March meeting. And we actually yesterday, my colleagues and I went back and looked. We only found one 50 basis point increase, and I think it was back in the 90s. So in other words, for 20 plus years, they've never done that. I don't see them doing it this time. I see them being cautious. I see them talking more. I see them barking more than biting. And because the expectations are so hawkish, I think we're going to have fewer than the market expects. I would say 3 to 4. Especially as I said earlier, I expect inflation to start to roll over. When inflation's tending back down to about 3%, when expectations start trending back down, when the headlines go down, I think a lot of the Fed's urgency is going to go too. So 3 to 4, and I think that's actually going to be better than what the markets expect, and that's a good thing.
Okay. All right, thanks. Potentially one of your favorite topics here, crypto. What's the potential impact on the valuation of the U.S. dollar, if any, from crypto?
Well, the question the short answer is slim to none. Okay, I really don't see crypto as being systemically important. And by crypto in this context, let me be clear, I mean private crypto. The Fed's now looking at a central bank digital currency. So in that sense, crypto could become important, but not with the stuff that's being traded right now. But the reason I say that is the world is priced in dollars. The world is not priced in Bitcoin. And because of that, you can't use Bitcoin to buy much. Now, that might change over the course of time, but you can use gold to buy things now if you're willing to jump through enough hoops. I think where Bitcoin is really going to have an effect, and Bitcoin is shorthand for crypto, is in countries like Turkey. Their economy is melting down, their currency is melting down, and so people are saying, wow, this is a safe haven. This is where I can store value. And if you're in Turkish lira, that makes sense. If you're in the dollar, do you really want to put your your wealth, your store of wealth in something that can drop 50% over a period of a month or two? If so, give it to me. I'll keep half of it and give it back to you in a couple of months. You know, we're a full service broker dealer. We can do this. Actually, we can't, but so as a store of wealth, I don't see it. I mean, I kind of look at crypto as a lottery ticket. It could take off. I'm not going to say it won't. I have a nephew who tells me I have no clue what I'm talking about. And he's younger and therefore much smarter than I am. On the other hand, he also buys NFTs at Bored Apes, which I think is insane. So I very much hope he's smarter than I am, because then he can support me in my old age. I'm not a huge fan of crypto. I'm not putting it down, but it's not an investment. It's not something that falls within my realm. It could be a lottery ticket, which also doesn't fall within my realm.
Yeah. Okay. So we've had people are working weekends trying to get caught up, and it seems like falling behind due to the shortage of microchips. Are there any signs that this, there's any I guess light at the end of the tunnel as far as that goes? And the other question is somewhat related here, and is around just-in-time inventories. So is there, any impact might be there, and kind of how that, what that potentially looks like? And again, like any end in sight with the chip shortage. Just your thoughts around that.
Sure. Honda in the plant there is not the only plant or company that's struggling with supply chain issues, and you know that. And, it's not the only industry. I mean, there's a ton of companies out there. And the problem we're seeing is, as I said earlier, demand took off. We saw people who were able to afford cars. We saw people who were taking public transit who now need to buy a car. We saw people who maybe lost their jobs that were now driving for Uber or whatever. So demand for cars took off at the same time as supply of everything, including cars, collapsed. And we saw prices start to go up, but we just couldn't keep up with the demand. So what's happening? Well, right now, we're still seeing that demand run extraordinarily strong, and supply has not caught up yet. We're seeing a lot of the semiconductor companies, they're going flat out. They're building fabs as fast as they can, but they still can't keep up. In fact, I think Intel announced they're building a fab out in Ohio. Isn't that correct?
Yes,
so,
yes.
So I mean, the companies are doing what they can do. And to go back to my point about Tim Cook at Apple, they're not just sitting there saying, wow, I guess there's nothing we can do, but it takes time.
Yeah. Yeah.
So, looking at it, are things still bad? Absolutely. Are things starting to get better? Yes, they are. And actually, what I expect to see happening towards the middle to end of this year is things will get better at an increasing rate. Because what you see a lot of the time in supply chains is called the bullwhip effect. And Google it, it's fascinating. But basically, when you start to get shortages, company A that normally needs 100 widgets, they know they're not going to get what they order. So they're going to order 500 and hope they get 20%. So you have all of these orders coming in at 500 widgets, and that pushes the demand up, and it makes problems seem worse than they are. But then once they start getting those deliveries and things start to normalize, then they're going to say, okay, we're going to cancel our 5,000 widget order. So, we're not there yet. We're still probably 6 to 12 months away, but you can already see that process start to work in a lot of different industries. And I think the fact that Intel is starting to build a plant in Ohio to be close to that Honda plant indicates that companies are doing exactly that. Now, to go on to phase two, just-in-time inventory. Just-in-time inventory is dead. I mean, for a couple of reasons. First of all, what we've seen supply chains optimized around economic efficiency, keep the costs low. They have not been optimized about keeping things running. They have not been optimized around robustness. And as we found out, that's a bad idea. And that has to change for a couple of reasons. First of all, we're seeing deglobalization. You can't count on companies and on factories in China to deliver what you need delivered. It's a shipping issue, as we've seen. It's a public health issue, as we've seen. So you're seeing a lot of companies relocating to Mexico, to Canada, to Ohio. But again, that takes time. And because of that, the reason the companies were in Ohio or factories were in China in the first place was because it was cheaper. So we're going to see costs go up. So we're going to have less economic efficiency. We're going to have more slack in the system. We're going to have higher costs. And that's all going to be the price we pay for a more robust manufacturing ecosystem. But it takes time to make that change. That's probably a 5 to 10 year change. We're going to get through the worst of it in the next couple of years, and then companies are going to be ironing out the kinks. I mean, the good thing is that's going to mean more jobs, good jobs at good wages here in the US. That's going to mean more demand for, say, truckers to locate things around, move things around the United States and North America. From a worker's perspective, it will mean higher prices. That's actually one of the things that will continue to push up inflation. But it's also going to mean more wages and more jobs. So overall, I think it's probably a good thing.
All right, thanks, Brad. We have time for one more question, and you can make this one quick if you can give us an exact date on this one. So when will the workers come back to the workforce? We have several restaurants here in town. There's help wanted signs in the windows. We have some restaurants that only open on Tuesdays, Fridays, something like that. McDonald's, I believe, is hiring $15 an hour here, and it seems like our restaurants still aren't open all the time like they used to be. So, and again, if you have a date that you can tell us when that will go away, then we'll be done here. But could you just talk about that just for a minute or so? Any thoughts around that? And I know you touched on it with some of the chart or one of the charts you had earlier. But when do you see this subsiding or more people actually making their way back to the workforce?
I will give you a date. It's July 31st. Note, I'm not saying what year.
Okay. All right. Fair enough.
No, the real issue here, Wes, is when are we going to go back to normal where there was an excess supply of workers and companies could pay whatever they want and hire whatever they wanted? And the answer is we're not going to. We're not going to. When you look at the growth in the number of jobs and compare it with the growth in population, especially the working age population, I've done a lot of research on this, so I can bore you about this for hours. So everybody sit down and relax. You're not going anywhere for a while. But the quick version is simply the baby boom pushed the labor force up above the number of jobs that were out there. So we had excess labor. So employers could hire when they wanted, lay off when they wanted, pay what they wanted. And that started to change through the 80s. And when you look at actual real wage growth over the past several decades, you can see a shift in the 90s, where all of a sudden the power started to shift to the workers because there were fewer workers in relation to the number of jobs. And in fact, we've seen real wage growth accelerate steadily over that time period as the imbalance has gotten bigger. And what we had with the pandemic was we had this shock to the system where we lost a bunch of baby boomers to retirement all at once. So all of a sudden we lost millions of workers. We also lost millions of people who were scared. They had kids to take care of. They had parents to take care of. They weren't coming back. So as you saw in the earlier chart, there's millions of people out there that simply haven't come back to work. And some of them aren't coming back. And the problem going forward is simply this: the number of jobs is growing faster than the number of workers. So when is it going to go back to normal? Normal before the pandemic? It's not. And you're going to see changes. You see McDonald's doing remote ordering because they have to. You see Walmart giving people significant wage increases, not because they're good guys or altruists. They may be good guys, but they're not altruists, but because they have to. And you're going to see a rebalancing of the US economy away from capital and towards labor.
Okay. All right. Well, thanks, Brad. Thank you for joining us. We appreciate it. We appreciate it as always. We don't want to take up any more of your time. And to the folks that dialed in, called in, if your question didn't get answered, we'll do our best to get that answered for you and send you an email response. As a reminder, this was recorded and it will be available on our YouTube channel and website in about a week. And keep a look, look in your email for a link to that or for our next webinar. And again, thanks to everyone for joining us. Thanks, Brad. We look forward to serving everyone in 2022.